We don't normally do these calls on Friday, but when we have a big economic report due that may move interest rates, then we will typically wait until Friday to do them. That is the case today. Personal consumption expenditures came out today. This is the Fed's favorite gauge of inflation. Did it help us? Did it hurt us? That's what we're going to talk about today. Glad you are with us. Today is the 27th of September, Friday. I hope you're doing well. I am Lance Bryce with Thrive Mortgage, here with your weekly rate update. Personal consumption expenditures, the Fed's favorite gauge of inflation, came in up 0.1%, expected to be up 0.2%. Year over year, the measure has dropped to 2.2%. Remember, the Fed's target rate is 2, so we're sitting pretty much there as far as what the Fed wants to see with regard to inflation. We were expecting 2.3%, so this report is a little bit better than expected. The prior year over year measured last month was 2.5%, so we're getting closer and closer to that Fed target of 2. Dow is liking it, y'all. Anytime you see a continuation of the Fed easing, as we now have more and more projections about where the Fed's headed, we're going to talk about that in a minute. The bond market likes it, but also the equities market likes it as well, and that's why you're seeing the Dow up. The Dow's up 400 since the Fed cut. It's up 200 or so on the day. So we are continuing to see equities, frankly, putting a little bit of pressure on the fixed income markets. You would see interest rates maybe a little bit lower on the strength of this PCE report were it not for all of the dollars flowing into the stock market. Very much these markets compete for dollars, and you are seeing more flowing into stocks, frankly, than you are in bonds today. So in any event, the CME FedWatch tool has updated their expectations for what the Fed's going to do in November. They now have a 57% chance that the Fed's going to move 50 bips at the November meeting on the 7th, 43% chance that they will move a 25 bip move to the federal funds rate. Here's why that's important, y'all. As we said going into the last Fed meeting, for the folks that waited until that Fed meeting, understand that rates were 6.15 on the 18th of September when the Fed met. Rates are 6.26 in the national average today. This is Mortgage News Daily's tracking of a 30-year fixed rate conforming loan. So rates are an 1/8 point higher than they were the day the Fed met and lowered rates a half. We went into that meeting explaining to folks that we've already seen very significant improvement. Remember that the bond market, when the bond market projects Fed policy, they're not going to wait for the Fed to actually do it. That's like saying, if I know a house is going to get more expensive on a set date, I'm going to buy it today before we get there. Well, the bond market does the same thing with these Fed expectations. They're not going to wait for the Fed to move before they price to market based on what they expect the Fed to do. So the game that we all play is, what's the Fed going to do? With these inflationary reports coming in more and more tame each month, the expectation that the Fed's going to continue to be aggressive, at least in these first couple of cuts, pretty sound. You see that reflected in the CME FedWatch expectations of this 57% chance of a 50 bip cut. Will that help interest rates? It's iffy, because we were sitting, y'all, in October of last year, just 11 months ago, at 803 in the national average. We're down to 626 today, so we've moved 1.75 points in rate in the last 11 months. We've already moved sufficiently to capture any improvement that we see at the next Fed meeting, right? So this next Fed meeting, we're not likely to see much more improvement, if any, than we saw this last week when the Fed met. It's important to understand that the bond market prices these expectations in. Now, when we get deeper into next year with Fed cuts, then it gets more murky. Then these reports that we start receiving, when we've captured this point and a half, 1.75 improvement, when we catch up with the Fed, then these individual reports will carry even more weight than they do today, and the picture will become more clear. But as far as the November Fed meeting, if they cut a half, y'all, we've pretty much baked that into the cake with current pricing. So if you're waiting until then, you're going to be disappointed when the Fed moves, just as you were this last week. Hopefully this is helpful as folks are planning for the future, y'all. I know this can be a confusing topic for a lot of folks. They see the Fed moving, they see those headline numbers, they think, wow, interest rates are finally coming down. Interest rates came down 6 weeks ago. They've been coming down steadily over the last 4 months to capture what the Fed has priced in or is likely to price in at their upcoming meetings. So can't say that enough. Folks should not be waiting for these cuts to be official by the Fed, y'all. We're already sitting on them. Had that same conversation with some folks today in anticipation of whether they should lock or float. I am still locking every contract the day that it comes in, y'all. There is no reason to wait. The upside risk far outweighs any downside potential, at least in the current market. So hope this information is helpful for you and for your clients. Stay blessed, stay safe. We will talk to you next week.